فليتفضل مشكورا.
Good afternoon, dear brothers and sisters. Thank you very much for coming to this discussion. Try to be more informal than formal in this discussion. Brothers talk to his brothers and sisters in terms of some of the knowledge that we have in the market. My focus today is only on the products, some of the product development. I have to put a disclaimer here that I did not put, or I do not put some of products in the market that you have seen lately. For example, I have not put the sukuk wakalah concept, which is very much in practice everywhere in the world. That is the secret of the business lah. No, I'm joking. So you don't have time to do that. With that only, I got 42 slides. If I put that sukuk wakalah with all the variations, we have more than 7 variations of sukuk wakalah in the world. So I put that, can you imagine, for the structure only, it take me more than 30 slides for that only. Last 2 months, I talked to Bar Council on the development of sukuk wakalah. Discussion on all the variations, it took me 42 slides for that. So I don't think I can put it here. That's why I just decided, just forget about it. Don't talk about sukuk wakalah, the variation that we see in the market. That's the first one that I don't have it here. The second one I don't have also. I'm not sure whether you are aware of the new fund that will be. I'm not sure whether they have established or not. That will be established in Qatar. Thomson Reuters has put the fund, what, 2 billion, something like that, worth of fund. That will be a kind of structured fund where the investment will be in so many variations, including structured product and everything. I don't have time to discuss about that as well, for 2 reasons. For the first one is for the time issue. The second one is still, I think, something that they want to preserve up till today, so cannot talk about that. And the last one also, I do not have in my presentation on the gold ETF fund. So those who come to hear about gold ETF, I'm very sorry, this is not the time to talk about that. Again, not in my presentation. So my presentation will cover only these issues. Okay, new introduction of new screening methodology, that's the first one. Islamic business trust structure, retail bond structure, corporate re-op with the introduction of ICARs and RALs, and the last one is issuance of perpetual sukuk. If you can see, even to discuss about this already, I put 42 slides. That's the reason why I don't include other discussion for that matter. Knowing that the other product that I mentioned also are new in the market, especially sukuk wakalah, which is the way forward for the issuance of sukuk, especially when you're talking about hybrid of debt and non-debt portfolio. Sukuk wakalah has been seen to be new breed, or what we call the way forward for the issuance of sukuk in Malaysia and worldwide. I think you are aware of the latest issuance by IIUM in Middle East, where they issue what, 750 million USD of sukuk wakalah, where the combination is very, very unique combination. If you have time, then we share about that later, inshallah. Let me focus on the thing that we have in our slide first. Right? Okay, this is the first one. When in 2012, SC introduced new screening methodology. Okay, new screening methodology. I think last 2 days or last 3 days, Bursa did some explanation to the market on this new screening methodology. Some of you may be there. Yesterday or last 2 days, I don't remember. Alright, this is the current screening methodology that we have. Right? You have the primary activities. I'll make it fast. Then you have the mixed company where SAC of AC put into certain benchmarks, 5, 10, 20 and 25. Based on certain categories and everything. Right? And the third stage is the qualitative analysis, where they go for something which is more toward assessment of the SAC members themselves. Right? Now, the thing that has been changed is the stage 2. The stage 2 has been changed. The changing of the stage 2 comprises of this. The first one is on the quantitative aspect, where previously you have 5, 10, 20 and 25. Now it is reduced to only 5 and 20. If you go back to the previous structure, the previous screening methodology, if a company, say for example, in 5 10% benchmark, they get 9.9%. And in the 20% benchmark, they get 19.9%. And in the 5% benchmark, they get 4%. And in the 25%, they get 24%. They are still Sharia compliant activities. But if you aggregate them together, they are actually having a lot of non-Sharia compliant activities there. 9, 4, 19, and 24. If you aggregate together, it's more than 50% of non-Sharia compliant. Now, the new screening methodology pulled them together. The one that in the category of 10 is now pulled down to 5. And those in the category of 25 is now pulled down to 20. So, the worst case scenario that the company can get aggregately in terms of non-Sharia compliant activities cannot be more than 25%. Okay, that is the new screening methodology that we have. Okay, 20 and 5. So if you aggregate together, it cannot be more than 25%. As compared to previously, it can be more than that. Right? And the second one is with the introduction of the financial ratio benchmark. Okay? The financial ratio benchmark, this is I think the 5% benchmark, as I lumped together just now, that those in the 10% category move to 5, and those in the 25% category move to 20. In that manner, so hotel and everything previously was under 25% benchmark, now it moved down to 20. Okay, and I put hotel, share trading and everything. Right. Another two benchmark that we have is that on the cash over total asset and debt over total asset. This is to verify on the interest earning or interest giving. Okay, interest earning and interest giving. It shall not be, the portfolio shall not be more than 33%. That is the scenario. However, we do not adopt the receivables screening methodology, financial screening methodology. Why in Malaysia, the way you are aware of it, we allow for the trading of buy on day. So if you put that benchmark, that will affect the ruling on the buy on day. That subject to another study whether we want to maintain the trading of debt allowance or not. That another category. For the time being, these two categories have been endorsed and to be adopted and to be published by the next in November 2013. November this year, you will see the new list of Sharia compliant company using this new guideline. November. Now, there are two things that get people worried is this thing. Okay, for the time being, we have more than 80% companies considered to be Sharia compliant. With this new screening methodology, of course, the number will be reduced. So, in the short term, that may affect the Sharia compliance, what we call universal. In the short term, it will affect that, definitely. We have run simulation, it will affect, I cannot reveal what are based on the current financial status of all financial position of the company, how many percent pass or fail, but it will definitely, in the short run, will affect the companies on the listed on Bursa Malaysia. However, in the long run, in the long term, you can see a lot of benefit in two things. The first one is the company, if they are serious in becoming Sharia compliant, they will have to put effort to make it more compliant. The second one is that we realize up till today, this company that are given the status of Sharia compliant activities, when we go back to their financing side and their deposit side, they are not serious in pursuing Islamic. The company is Islamic, yet when they do financing, a lot of conventional financing there. For the time being, the current scenario, the current screening methodology does not tackle that issue. One company that we take is a Sharia compliant status, yet almost 100% of their financing or their loan are conventional. So now we are talking about A to Z halal. Halalness, if I can use the word correctly, the halality, whatever you want to tell me. So now with the new screening methodology, the company will have to put effort, if they want to be considered Islamic, to ensure that not only their business is compliant, but also how they finance their expansion and everything has to be compliant, and also deposit where they put their money has to be in Sharia compliant deposit as well. So it will help Islamic finance in the long run. That is the intention. Not the intention lah, the consequence of that. I cannot say much lah, but that is the consequence of what will happen. Not to reveal the intention lah. That the consequence of that will happen. The company that want to be Sharia compliant, they have to ensure that their financing, if they want to even go for loan, they have to go into certain bracket only. They cannot go more than that. Okay, there is possibility that over time we may strengthen further this recognition. The situation that we take in Malaysia, we take a very pragmatic approach. When we started, to introduce to the market, we put 5, 10 and everything. We believe the time has come for us to strengthen further that regulation, to ensure that people see more seriously when they talk about Islamic finance. A company who want to become Sharia compliant company has to take more effort to become more compliant, not only in the production of the asset that they have, they produce everything which they stamp as halal, but not only that, but also in terms of their financing and their deposit. The way they do financing, expansion and everything has to be Sharia compliant. That is the thinking behind this move, which I think a good one. Some players in the market access said, my God, what happened to the company? We have a lower number of universal Islamic securities. I said, never mind, short run we may have a problem, but in the long run that will benefit the industry as a whole, rather than only the capital market and the exchange only, equity on the exchange. Okay, this is the first one. Coming to that, after that, the introduction of what they call business trust, with the amendment made to certain clauses in the CMSA and the issuance of the guideline of business trust, including also Islamic business trust. Okay, what is business trust? Means simple, it is kind of unit trust scheme. It works the same manner. The only difference are in two things. The first one is that in unit trust, there will be separation between a trustee and the manager. The trustee cannot be the manager cannot be the trustee. That is in unit trust guideline. In business trust, trustee is the manager is the trustee. So it lump in one entity. So the manager who manage the fund, who manage the business trust, is also the trustee for that fund. That's the first one. The second one is that if you go to REITs, for example, the underlying must only be REITs. If you go to trust fund, for example, you have to determine your unit trust. Your unit trust is what? Is it equity unit trust? Is it bond unit trust? Is it money market unit trust? Is it balance unit trust? Whatsoever. You have to determine what is you. In this business trust, you don't have. You don't have. So once you establish as a business trust entity, you can come to the market, okay? You can offer your unit, and your unit can represent a lot of underlying, not only one underlying. It can represent a lot of underlying. Okay? As long as it is within definition of business trust, then it is acceptable. The one that I mentioned here is that unit trust is a unit trust scheme where the operation or management of the scheme and the scheme property or asset is managed by a trustee manager. The word is trustee manager. They are same party. And this trustee manager is the person that did that. And what is the asset? All type of property or asset, including real estate, securities, business undertaking as well. Okay, so you can be